So, the topic of discussion for this presentation is what are the common mistakes done by the corporate taxpayer in relation to a Singapore company. So, the typical mistakes those are done in claiming expenses or maintaining records are as follows. The first mistake that many small companies do is not maintaining proper books of accounts. So, under Companies Act, it is mandatory that you maintain a proper set of books of accounts, and generally you can maintain it by some online system like QuickBooks, Intuit. There are so many options nowadays available. In case you don't want to maintain it, or if you do not have accounting background, you can always engage a firm like ours. But you need to maintain this proper books of accounts, and what it means by maintaining proper books of accounts is to maintain a set of accounts which consist of general ledger, cash book, bank book, listing of invoices, and listing of purchase invoices. Ideally, it should be maintained in the software which complies with the Singapore Financial Reporting Standard. The next mistake is of claiming personal expenses in your company accounts. Sometimes the companies tend to be very small, and promoters of the company try to take the liberty to claim all these expenses to be part of their business. For example, even if they go out for a evening dinner with their family, they will claim it under the company account. Or if they are going somewhere for personal travel, the air ticket and hotel expenses, they might try to book it under the company. Now, this is not logically correct, and you should not do this. In case it is found at the time of tax audit, then it can be significantly costly for you. The next mistake that they do often is claiming undeductible expenses. So the previous point was personal expenses. Here the expenses might be related to business, but they might be undeductible. So there are few categories here. For example, if you make additional contribution to employee CPF, then that is not deductible business expense. If you incur any capital cost, which ideally should be written off as a depreciation, then you cannot claim that fixed asset cost to be expenses in the first year itself. One more example is that if you are running some other project and order something or incur expenses on something which is not really related to the main business, then again you cannot claim as a deductible expense. The next mistake they often do is not issuing invoices or collecting money in cash. So what happens is this is one of the serious offenses considered by IRS. So sometimes what people do, especially very small business owners, they will not, where possible, they will not issue the invoice and try to collect the money in cash. So this sale, this specific sale where the invoice is not issued and money is received in cash, does not get accounted anywhere. And because it does not get anywhere accounted, it will reduce down your tax liability. So never engage in this practice. Even if the customer is not asking the invoice, create the invoice in your system. So you don't have to really necessarily print and give it to him if he doesn't need it. But the record will remain in your system. If possible, avoid collecting money in cash. But there are some businesses where collecting money in cash is a norm. So in that case, whatever money you have collected in cash, deposit it on a daily basis to your bank account and make the proper entries in your accounting software. The next mistake that I've seen that they pay to related parties without a reason. So I am running a business. Maybe I'll get my wife to act as an accountant. Maybe I'll get my son to act as a marketing manager. Both of them are not really working in the company because my son is going to university and therefore he is not coming to the office. But I just on paper show them to be employed with my company and I'm paying them the salaries and claiming that as a business expenditure. So as you have seen in the situation itself, it is not logical because unless the person really works for your company, you should not be paying any salaries. And the last one is paying excessive salaries. So sometimes what happens, people engage their close relatives. The relatives might be working for the company, but the salary given to them is significantly high compared to what function they are doing. For example, paying salary of $200,000 for a junior accountant. That's definitely wrong. And the last mistake that many people do is not maintaining background documents. For example, if you purchase something, maybe stock, then the documents of that should be available with you either in the paper form or in the form of electronic receipts. It can be maintained in PDF, it can be scanned and kept. So whatever way is possible, it should be maintained. If your company is selected for tax audit, then you will need to show all these documents when the tax authorities come to visit your premises. So in summary, don't make these mistakes in your corporate tax return and don't get caught in the net of the law.
Thank you for watching this video. This video was brought to you by Epica Consulting Singapore. Subscribe to our channel today to get notified when new videos are posted.